Nice to at least see everyone and hope everyone's had a lovely week. It's Thursday, April 15th. My name is Regina Campbell, and I'm coming to you from the Campbell Law Group. We're here today to talk about an important seminar that's actually affects quite a bit of people's lives in one way or another. Today, we're going to talk about the importance of financial documents in family law cases. And this is a subject that in one way or another, it's probably touched a family or a friend or someone that you know, whether it's with regards to a divorce, a paternity action, or in drafting a family law agreement, such as a premarital agreement, postnuptial agreement, or even a marital settlement agreement. So today we're going to talk a little bit about why financial documents are so important in these types of cases, okay? And they really can make a difference, a crucial difference as to how the case goes, to protecting your rights, to making sure also that your rights are not trampled on, that you're not giving away more than you're required to, and that you understand the nature of some kind of distributions, whether it's in creating a pre or postnuptial agreement, or actually a divorce and a marital settlement agreement, or through a divorce proceedings. You want to make sure you understand why you're asking a judge for certain relief, because you might be surprised to know that you're actually asking for an asset that may not even be, for instance, in a distribution, it's actually not as valuable or not worth what you think it is. So today we're going to talk a little bit about how do you make those determinations and the use of financial documents in family law cases to make choices and to strategize and to protect your rights. Okay, and to be able to see what's going on with the other party's financial circumstances, because often financial documents on the face of the document doesn't really say the full story. So we'll go into a little bit about that now. Okay, here we're going to go. This is the agenda. First, we're going to talk about mandatory disclosures and why they may not be enough. Financial affidavits, certificate of mandatory disclosures fall within that category, and we'll discuss that a little bit further. We're also going to discuss alimony. So determining income for alimony purposes, why is it so difficult? We're going to talk a little bit about why it's not just, hi, I make this amount of money. You must look beyond the surface of just a W-2 potentially, depending on what type of wage earner they are, if they have other sources of income, the other party. So unfortunately, it's just not a black or white question. Would be a lot easier. Judges would love that if it was the case, but it is not. Most of the time, it's one of the most heavily contested areas of the family law case. The second part of the alimony is also determining a spouse's need for alimony purposes. We're also going to talk a little bit about child support, determining income for child support purposes. We are also going to talk about equitable distribution. Some of the terms underneath here are understanding your assets and liabilities for division, the importance of appraisals and valuations, protecting non-marital assets. I'm going to show you a little bit how to do that, and also how to protect maybe if you're on the other side, actually protect the marital portion of a non-marital asset, if that is the case, and also recovering marital assets, which often seem to disappear in the years before a divorce. Also, most people don't think about this, but there is an importance of financial documents when drafting pre- and post-nuptial agreements, as well as marital settlement agreements. So let's see here. I'm sorry, let me just go on to the next one. Okay, so mandatory disclosures. Basically, why are they not enough? So financial affidavits are actually really important tools in a family law case, particularly in Florida. And the financial affidavits require each party to fill out all of their expenses and their income and assets and liabilities that they have, either at that point or potentially prospectively, which is kind of tricky to do. You're supposed to indicate a current financial circumstances, but sometimes people do a prospective financial affidavit or a portion of it aligned with what their needs are going to be after the divorce. So for instance, they, presuming they won't have a mortgage anymore, but their rent or a new mortgage would be X amount. So they might be accounting for, especially when you get closer to trial, you might be accounting for what you believe the expenses are going to be after the divorce. But often it reflects current circumstances and potentially what you might need now on a temporary basis or what you have currently. So this, one of the most important things to look at and think about when you look at financial documents is, what am I looking at? What does it really reflect? What does it really say? Is it telling me the way it is now? Is it telling me what it can be like in the future? Is it telling me a false story about maybe the way it was in the past? However, the financial circumstances have changed, so maybe no longer these documents reflect a current circumstance. These are all things you want to keep an eye on. For litigation purposes, strategizing as far as settlement, and in general, understand what you have to work with. Certificate of mandatory disclosures are the minimum disclosures that are required by the state of Florida. And they basically, they basically indicate that it's, a limited amount of disclosure. So minimum, I like to say minimum mandatory, shall I say. So it might be, 3 months of bank statements, a couple of years of tax returns, a 1-year brokerage statements or insurance, but there is a limit, it's limited. And we'll talk a little bit more about when this may be enough, but in most cases, unless you're very well familiar with your other party's financial circumstances, often it will not be enough, okay? So we go into, I love this. This is my litigation manager, Ricardo. I was chuckling when I saw him put these pictures in, but it's actually so apropos. So mandatory disclosures, why they may not be enough. As we were talking about a moment ago, they are limited in time. Sometimes they're good for strictly W-2 wage earners with limited assets. So for instance, when you know what the other party makes, there's not too much concern about the other party having another source of income or assets that you may not be aware of. And you're familiar with each other's assets. This may be sufficient under those circumstances. Tax returns. Tax returns don't always tell you the whole story, especially when a business is involved. So it's really important to look a little bit deeper, and often the mandatory certificate of mandatory disclosure requirements just do not say enough. You may have to get into business financials and understand kind expenses, other type of compensatory sort of avenues, whether it's stock options, with retained earnings that are being held without really need in order to make it look like, to skew the income flow for purpose of support. So it can get a little complicated, and we'll talk a little bit more about that down the road in the webinar. The employment compensation has become increasingly more complicated. This is also why it is just may not be enough for mandatory disclosures. If it's just a strictly W-2 party, and there's no indication there's a lot of cash flow somewhere else or some other source of income, it may not be so complicated, and it's fine. However, you have circumstances when you have stock options, the exercise of stock options, which might be a one-time event, not recurring, in which case you cannot use that for income for support purposes. You have also skewed numbers when you look at potential W-2 forms, and you have to also look and see if there's been any retirement distributions or sort of contributions to a plan. You have to see if they're mandatory or if they're voluntary, because that could be money that, if it is voluntary, potentially you can require or ask for it to be put back in for income purposes. Also, more than likely, mandatory disclosures will be insufficient, like we're talking about, in a case where there's a lot of cash flowing around, there's a likelihood of financial gamemanship, or divorce planning has occurred, because often it's just not going to tell, it's not going to tell the full story. So you're going to need to go a little bit deeper than the mandatories, especially in those particular type of cases and circumstances. And where you see complex assets, complex income, so to speak, and how to determine that. So here we go. So determining income for alimony purposes, we're going to go into a little bit further. And this is the Florida statute that indicates here, how we figure out how the statute defines income for the purposes of figuring out how much money someone has for alimony, to see if they have the ability, in other words, to be able to pay alimony. Alimony is a component of two particular parts. Its ability to pay, its need first, establishing the other party that has lesser income or less ability to make money has a need. And then the other aspect of it is an ability. Does the other party have an ability to pay for the other spouse's needs? So a party can have a need, but if the other party does not have the ability to actually pay for the other spouse's needs, alimony will not be ordered. The court may decide to sort of even out circumstances and equitable distribution if that ends up occurring, but it's a highly fact-intense area of law. But so you can just see a little bit here. I showed you the definition because it really encompasses everything. Okay, and what you don't see here is potentially other alternative sort of investment types and sort of compensations. So, but it is meant to be picked up in here in general, any kind of income that can be generated, of course, if it's recurring. So you really need to look under the surface. And this is why we're talking today about the importance of financial documents and what they can tell you in family law cases. So determining income for alimony purposes. Other reasons why income is so hard to determine is tax returns. tax returns are actually, what they don't say is often more important than they do say. People do not realize, but tax returns are actually not the end all be all. There actually is a lot of money that can be sort of hidden in deductions, expenses, depreciation expenses, little tricks that people have learned. And by the way, it may be legitimate for IRS purposes. There may not be anything fraudulent that someone's doing or taking, but for alimony and child support purposes, it's a lot of those expenses can be thrown back in and be considered income. And that's kind of where the rub is. That's why it's not so easy to determine income in many cases. Again, we talked about employment compensation. How much did you make? Question here is income versus cash flow. A lot of times someone can report income on a K-1, or that they received income and they're being charged for it, so to speak, or being taxed for it, but it may not actually have flown down to their level, flown down to the personal level where they actually received it, is the best way to describe that. So if they're not actually receiving it, part of the problem is, depending on if that's a one shot or if it's going to be frequent that they're not likely to be receiving in the future. These are just, for instance, expenses related to depreciation write-off or other capital sort of expenditures. You can't really use it for income purposes for support. So you have to keep an eye on that. It's not fair to require someone to pay alimony on money they never actually received. Okay. Now, the opposite is also true. A lot of times you have people that will hold back, spouses that hold back distributions and keep money in the company purposely to reduce their income. So that's also something you need to look at, because if they control the ability to issue distributions, or kind of play with the numbers and the in-kinds and stuff, you want to look further into that, because that's where additional money could be flowing actually to the personal level for income for alimony purposes, but they're purposely kind of hiding it, holding it back. So again, also this doesn't include anything related to stock options or alternative or type of investments that actually produce income. And some higher net worth individuals, that becomes even more complicated, and you really need to have an accountant and a chart to figure out all the income from all the different sources, so you're really understanding alimony or income for those purposes. And then we'd like to say the number one reasons: divorce, poverty. And we are back to the wolf on Wall Street with this one, or the Madoff-like behavior, which he just received news that he just passed away yesterday after being responsible for a $20 billion Ponzi scheme. But divorce poverty is something that courts are well aware of, attorneys well aware of. It's amazing how quickly money dries up, or the business is not doing well, and we have to start selling the assets, honey. And this weird behavior starts to occur, a year, 2 years, sometimes just months before the divorce. But some people do plan for a couple of years ahead of time, and they want to make sure that they're poverty stricken, so to speak. So they may even be, asset rich but income poor, so that they try to avoid alimony. So this is why determining income for alimony purposes can be rather complicated. So I wanted to, let me see here. Okay, so let's move on to the next one. Okay. So determining a spouse's need for alimony purposes. Okay, so this can also be tricky, because this is another source of heavily litigated area. This is where you're going to see the payor spouse, or the person that's likely to be paying the alimony, is going to say, hey, my wife doesn't need anything, or my husband doesn't need anything. They don't need vacations. They don't need food. They don't need house. They don't even need alimony. So just because they've been a homemaker for 40 years, it doesn't matter. They don't need it. They can live on their own. It's amazing how all of a sudden the other spouse's needs are nothing when it comes to trying to figure out their needs for alimony purposes. On the flip side, the payee spouse at times all of a sudden believes that they once lived in Versailles, and that they had 20 maids and they would like to maintain that lifestyle. So you see each party has its own specific incentives, to basically, decrease the needs so that the alimony amount is potentially less or nothing. And then you have the other spouse that wants to increase it to continue to live the way that he or she used to live during the marriage, and potentially even beyond, so that they can get a windfall in some cases. So where the importance of financial documents comes into play, and like we talked about also a little bit on the income side, just to go back for a moment, looking at business financial documents can tell you a little bit more about the actual expenses. Are there any family members on payroll that their income could be attributed back to the overall profitability of the company? Just to give you some ideas. So you look at the financial statements, the balance sheets. You want to look beyond the surface at the actual detailed ledgers on expenses and in kinds and car expenses, so that you may be able to derive additional income from there, and you're able to assess the veracity of what these financial statements say. So in some cases, of course, the personal tax returns may not be sufficient. You may want the business tax returns that have various schedules. The schedules will tell you if other companies or affiliates exist. It tells you the assets that the company owns, tells you the write-offs and depreciation. If all of a sudden you have someone that's front-loading a depreciation expense, that's usually a red flag that they're trying to reduce their income in a relatively short period of time. Look at the business, look at the salaries, look at who's being receiving salary, car expenses, are they really necessary? All of that kind of stuff, all that information is contained in these business sort of financial statements and tax returns, and can be used to add back for income purposes. The employment compensation also, just to briefly go back to it for a moment, the kind of documents that you would want to have for employment compensation to get an idea is not just pay stubs, but also payroll summaries. You want an end of year. You want to have a detailed explanation as to where every deduction, every amount went, and with the gross wages of the party year. Because often for instance, one of the top lines of the W-2 only indicates taxable wages. So it's going to exclude anything such as retirement sort of set aside sort of distributions into an account, because they're not taxed. They may be tax deferred, in which case it's not a true reflection of the person's actual gross wages. So you need to look at that. Plus you need to look at stock options. Are they vested? Are they non-vested? What are the conditions for them to be vested? Is there any value in the period of time in which, prior to being vested, that might be considered a marital asset? Pension accounts too, a lot of times are subject to, portions of them are marital. So you want to look into that and have the plan benefit person do an analysis or give your report on what they believe the marital portion is. You also need to look at if someone's going to have deferred income in the future. Is that potentially a source for either income? If it's not income, it could also be a source for equitable distribution as well, depending on the nature and the characteristics of the compensation and when it intends to vest and why it's being deferred. Not on this list also, it kind of goes under divorce property. A lot of investment documents will show you transactions. They'll show you people moving money around, and you got to look at brokerage statements. When you see money proceeds coming in and coming out, are they just from the redistribution or reallocation or rebalancing your portfolio? Or is it a sign that someone has actually liquidated some assets and they may be transferred? You want to look at withdrawals, wires. This is also why it's important not to just have a year or 3 months worth of documents, really at least 3 years to get a good idea. And of course, once you look at the 3 years, those documents in any one of these categories might also say, okay, you know what? I got to go further back. It looks like they've had an account for some time I'm unaware of, or they may have received income or sold a property and you're unaware of, and they put it in their mother's name, their sister's name. So sometimes going back, I usually try to shoot for a minimum of 3 years. Depending on the circumstances, I might go up to 5 to be able to track back some of these pre-planned sort of runs from the marital estate. So in other words, people were planning ahead and you want to see what's really going on at the surface. So for purposes of actually determining needs, the kind of financial documents that are important for both sides. So in other words, if the wife or the husband tries to indicate they used to live in Versailles and have 20 maids, your bank statements and your expenditures, your credit card expenditures, are going to show a true story of what the person's needs may actually be. And there's often components of alimony that people cannot claim as a need. So for instance, if you used to save money, the wife or the husband, they can't say, well, I used to save $400 a month, so that should be part of my expenses. That's going to be not permitted. So there's certain things that are not permitted. So it's really important that you take apart those numbers and you actually go to financials and documents to prove this is the amount of which you actually need what we actually use during our marriage. And the same goes also for purposes of if someone is trying to say that you did not have those needs and we didn't have those expenses and we didn't take those ski trips to Europe. Well, here are the documents. Here's my credit card statement. Look at a picture of us on the beautiful slopes with all our children. And that becomes very hard to refute. Then it becomes, of course, a battle of I don't make the same amount of money as I did before. That's the other issue we were talking about, more related to income. So financial documents can be very important. Also, just determining need, if some of the needs were met through sale of assets, you want to be able to show that. And part of the problem is, did those needs, are they one-time needs at the time, and in which case we had a little bit of bump of money that year, so we spent more money, or did you consistently have sale of assets or other things that bring in money that allow you to live a certain lifestyle? So you want to be able to document your lifestyle and your needs as best as possible, and it would also make litigation less expensive if you're able to do that. So determining income for child support purposes. Basically, this is very similar. This is also the statute for determining income, for all the income you basically pull together to figure out, what somebody is making, the parents in this case. But it's very similar. It's very broad, just like alimony. The only difference with child support, we need to get to a net number. Although alimony does ultimately deal with that net number, takes into considerations tax, depending on how the judge figures it out. Some use gross numbers and they use by percentages of the gross numbers between both parties to figure out a rough number that's necessary for alimony. But most of the time, the judge needs to take into consideration, of course, an end result, which includes reducing any gross wages by, required mandatory sort of deductions, which include income tax, child support, or alimony being paid for a prior wife or child. So that's just something to think about. That's not necessarily different. Here, the statute specifically goes into it that in order to come up with the child support number, the parties have income, very broad definition, broader than what the IRS, determines as income. And then it's able to be deducted. The only proper deductions in order to get to a net income number are these, which are, mandatory retirement payments, health insurance payments, excluding payments for a child, court-ordered support for other children, which is actually paid, spousal support, ordered from a court order for a prior marriage, also federal income tax, of course, federal, state, and local income taxes, federal insurance contributions or self-employment tax, and mandatory union dues. So we basically take the parent's income, including the parent that be receiving alimony, although they don't have necessarily an income tax portion to deduct. They don't have an income. They don't have to deduct taxes from their alimony payments, at least as of now. So, but you take the number, and you're already at a net number with the wife's or the husband's, right? Alimony amount, and you plug them into here. You get to a net number for the other party, and you basically get to a net number so that you can then figure out, based on the child support guidelines, what child support each party should have to pay. What percentage of the child support each party is required to pay. Now, most of the time, you're going to have one party, of course, that makes more than the other, so they're still going to be paying the other party the difference of what their share should have been, which is also takes into consideration overnights and credits of health insurance and childcare and stuff of this nature. It's an equation that goes together. But for the purposes of today, we're just kind of going into the importance of the financial documents and why this is important, also even for child support purposes, for income purposes as well. Everything that I've described and discussed about alimony and the need for certain documents to figure out income also apply equally to child support to figure out income also. The needs are different. The needs are decided in accordance with statute, unless you have high income earners, in which case you have the ability or special needs to deviate from these guidelines. But for the most part, you need to get to a net income number, which is a little bit different than alimony, and then you run the guidelines. There are guidelines for this from the state. So far, the state of Florida has not adopted any guidelines for alimony, which is also why it's heavily litigated. Not an easy task to do, even if they tried. But in any case, this is what we have right now. So we're going to move on a little bit here. I mean, this is what we basically talked about. And here is to figure out the difference, who pays. Each party has to pay something. And by the way, if you have an underemployed or underemployed or unemployed sort of parent that is intentionally underemployed or unemployed and is not needed to stay home, for instance, or that's not the normal customary sort of behavior from that parent to be able to take care of the child, either way, that there'll be imputed income basically to that parent, because every parent in the state of Florida is required to contribute to the support of their child. And obviously, everyone's ability is different, so the state tries to take that into consideration. But the state will also figure out in the child support calculations, it'll indicate what party has what percentage, so to speak, of also their prorated sort of percentages for the additional child support, which is such things as extracurricular, unreimbursed medical, and other expenses. So I try to simplify a little bit more about child support income, sort of it's brief. Obviously, it can become more complicated depending on the circumstance of the child, but that's the nuts and bolts, so to speak, of figuring out income for purposes of child support, and the type of documents that you need is very similar to the ones needed for alimony. So here, equitable distribution. Often people just think a little bit more in terms of black and white with equitable distribution. Okay, I'll take that brokerage account. That's 250,000. Okay, you keep the house. That's 250 over there. And it's not necessarily that it's wrong or that it's be such of a difference, but you'd be surprised. Some of the things I want to sort of expressing today and why financial documents are so important in family law cases is understanding your assets, for instance, in liability division. So that same brokerage statement that is basically, actually, you know what, I'm going to take a step back and we'll just go through the terms and then I'll go one by one into the importance and give you examples of why financial documents are important for understanding each one of these areas. We're also going to briefly touch upon appraisals and valuations, protecting non-marital assets, and recovering marital assets. So I'm going to talk to you a little bit about the importance of financial documents in each one of these categories. So basically, to go back to the conversation about why, so for instance, one party keeps a brokerage account, the other party keeps the house, okay? So part of the issue here is you need to make sure you're looking at what are the obligations that come with the house. Is there a mortgage? Is there a balloon payment? Something that, in other words, is there something that you cannot be able to pay? Are you intending to sell it? What is going to be sort of the after-tax sort of dollars or you're going to receive after this, or even after closing costs and so forth if you are going to sell it? That gets a little tricky in terms of for litigation purposes. If you don't intend to sell a house, you can't necessarily claim in Florida the cost of you can't reduce the sort of the equity and the property by the cost of the closing costs if you don't intend to sell it. But those are little nuances just overall to talk to you a little bit about how do you select select assets. So the brokerage account also, the house may seem like a more logical, stable choice. It may resolve check certain blocks for that particular party. I don't have to worry about moving. The kids and us are going to stay here. It's close to their school. And that also has value too, in addition to maybe what equity amount might be there. So we do want to put that sort of in a column and take that into consideration. The kids are happy here. They've been here, 10 years, 12 years. So those are some of the things that are non-financial considerations. But today we're going to talk a little bit about how you look at it from the financial point of view. The brokerage account, okay, it's $250,000. Great, I'm going to take this asset. What that party may not be understanding is basically, first of all, it's fluctuating. So that $250,000 could be $200,000 tomorrow, potentially, if there's a drop in the market or a month later. Okay. The brokerage account could contain large tax liabilities. In other words, depending on the cost base of the assets that are in there, whether it's a stock or it's an alternative investment or it's a partnership, whatever have you, because they're all taxed differently and may have a huge tax liability. And when you go to actually sell it, you end up with, instead of $250,000 in sort of money or value, you might end up with 190. Okay. So as you can start to see, those type of decisions, it's not always apples and oranges. It's not like cash, for instance. So checking account, this checking account is 100,000, it says 100,000. I'm not so concerned, unless there's something strange with those checking accounts or the monies, particularly what they represent. They're pretty much going to be the same thing in terms of tax effect, so to speak, of the distribution of what you receive. You're going to get 100,000. This is 100,000, of course, barring someone taking money out before you actually get the distribution. But that's more of an apples to apples comparison. Other assets are not that easy to actually determine whether or not you should choose them or not. So when choosing what assets, potentially, or even liabilities to actually take or to agree to in a settlement or potentially at a trial, you want to look at all aspects of it. Some investment vehicles actually contain, it's like hedge funds and certain other type of alternative investments also require they have capital calls. So it might seem great. It might be producing some income, fairly low tax, great tax, basis or cost basis, and a relatively low tax basis at the end of selling it, depending on how it's structured, the characteristics of that particular fund. And that's rare, but if that's the case, but you may want to look underneath the surface and see, is there a capital call in the event of certain circumstances that you take that asset and you might be required to fork over $100,000 on a capital call. That may not be what you're intending. You may not be used to those type of investments. It may not be beneficial for you. Also, there's sometimes that there's more value to another spouse to actually take assets that have losses because it'll offset their income. So, there's various different reasons. This is why working with an accountant and your broker is very, very important in a financial planner, especially if you're not used to planning for the future as far as your expenses and understanding these different vehicles. So one of the biggest stories here. So in other words, how do you pick these assets and liabilities? You have to look at the different characteristics and actually understand what it is you're getting. What is the actual value of the asset you're getting? Are you inheriting some additional obligations and liabilities that you do not want? What are the tax implications when you go to sell it, whether it's now or in the future? And also, does it remain fair and equitable to each party? When you actually take each of the assets, you put them on a piece of paper and you figure out, you tax affect them, you figure out what kind of income they're producing in the future, which, by the way, some of the income being produced by an investment property would reduce someone's alimony need, or it's going to increase someone's income over here. So these are things that need to be determined so you can also figure out the other sort of equations also related to income and alimony and so forth post-divorce, assuming you're at that stage. So this is why documents are invariably important. You can also see whether or not there is, with companies, there could be a huge retained earnings or distributions pending to be issued, and in which case it's not being considered, in the value of it. This is where an appraisal or an evaluation, a business evaluation, which we talk a little bit more over here, is very, very important. A lot of people just say, the company, my husband says the company's worth, the book value on the company is $400,000. So I'll tell that the business is worth $400,000. It's not worth $400,000. Book value rarely reflects the actual value of a company. So it's important to hire someone that can actually do a proper evaluation, can assess also its discretionary expenditures, because it does, in other words, to give the company potential multiples on its valuation, depending on its income, its net income, and depending on the certain characteristics of that particular business. It could also have some tax benefits within the business itself that are beneficial. There could be additional assets. Keep in mind also looking at a balance sheet, particularly any financials, or a particular tax return on a business tax return. Any cost of, or any sort of a value of assets that are listed on the tax return are going to be historical costs, not the actual cost that it is or the value it is today. So this is why I was kind of going full circle, try to explain to you business or personal income tax returns do not always tell you the full story. So it's important to look beyond and look at the proper documents, financial statements, brokerage accounts, operating agreements, anything that might be necessary, retirement plans, stock option rights and plans, and when they vest and the different terms of them in order to make decisions. And in here, this is where an accountant and evaluator can be very important. Often I find people also want to sell a property. Oh, it's worth $500,000. They don't actually stop to do a formal appraisal. And later on, they find out that it was worth less or worth more, and in which case they ended up taking an asset. They ended up getting less money in the division of the assets than they expected, or potentially someone got more. And the other party becomes sour grapes, and then he took the wrong asset and it devalued and so forth. So understand what it is that you're actually discussing it, and when you're trying to settle a family law case or litigating a family law case. That can lead to also assistance and lessening the cost of litigation when you have these answers to these questions when you have these answers for the judge. So when you're describing why a certain division or proposed revision is unfair, you can explain to the judge, articulate, preferably through the testimony of an expert, why this may be unfair. They can take apart the different elements of it, and in which case the court can more appropriately apply case law to that division, taking into consideration all the factors, and potentially do equity somewhere else with another asset to even out the parties if it's necessary. If not, you're losing this. You're leaving the money on the table, as they like to say. Okay. This is what we talked about before: distribution and taxes. Not all assets or liabilities are created equal, and we've kind of talked, and I'll give you an example of that. Understanding the true value of what you're getting and the cost of that asset and liability down the road is really important, crucial, very important to post-divorce life also. You have to understand what it is that you're working with, what you can afford, and your choices and what you need. And, whether it's to get a certain job, to move to a certain area, what assets and income do I have to rely on? Very important to recovery. And it does help a lot to have a better transition in general when you're financially more stable. It's an easier transition to a post-divorce life, easier for the children, easier for everybody. Also, take into consideration sometimes some parties, and we said that there's also non-monetary considerations to take into effect when you're thinking about this. Some parties prefer, for instance, to have a more stable, I'd rather have the house, it's a little bit less, but it's something I can touch, so to speak, something I feel more comfortable with, that type of asset. There's also some people they're concerned about getting paid alimony over a term of 10 years. They may prefer to have a little bit more cash or a liquid account, even though they might be taking a little bit lesser. in general, than an equitable distribution or equal distribution under the law. Those things are considerations, but you still need to understand the baseline in which you're working with in order to make those decisions. And that's kind of the thrust of what I'm trying to get to today in the importance of financial documents. So basically also we have here protecting non-marital assets. In a divorce, a party is able to protect his or her non-marital assets, from distribution as a marital asset, right? However, in some occasions, depending on what the parties did, there could be crossover. There could be some contributions to a non-marital asset during the marriage that converts part or the whole asset itself into a marital property. So keeping good financial records of expenses, of labor, of increases in certain non-marital assets as passive appreciation, all these type of documentation, discipline to keeping these documentations. I know it's kind of hard because you don't want to be thinking about honey, this comes from, the light bulb comes from your account, the groceries comes from your account, the light bulb for the house comes from mine. I'm not saying you have to get to that level of extreme, but when you're taking into consideration, significant improvements or labor or income going into a non-marital asset, you want to have clear documentation of what was put in from a marital pocket or what was put in from a non-marital. Did you pay for improvements from a non-marital sort of other source, other checking account, or other assets you may have sold, and in which case there's no commingling. This becomes very, very important to protecting actual non-marital assets or proving that a portion of a non-marital asset is marital if you're coming from the other way. So once again, another example of why financial documents, depending on the circumstances, what type, whether it's credit cards, it's receipts on improvements, why they may be important. Okay, so here, and I'm dying with this picture, my litigation manager. Just goes to show you how everyone has different perceptions. Apparently here, his perception is the wife gets everything. I will not tell my best friend that is his wife that this is perception, because otherwise she's like, oh, okay. But in any case, I thought it was a really cute picture. Recovering marital assets. Hopefully some of the other assets are, it's more equally, between the two sides of the cake. Although I'm looking at that cake, it's very delicious. I love cake. But there is times in which you can recover at least up to 2 years, in most cases, 2 years. Sometimes you can go beyond if it's sort of the fraud or the fraudulent transfer continued beyond that time, and you can trace that. But typically, as a rule of thumb, work with 2 years, as the statute indicates. You can go back to and recover any wasteful dissipation of marital assets that the other party may have done, whether it's fraudulent transfers to a family member, use of marital funds for a girlfriend or a boyfriend, an extramarital affair, sort of, just spending money on, all of a sudden they start gambling or they start doing other things that are inappropriate so that they can dissipate the marital estate, so to speak, for distribution purposes. This is also particularly where financial documents come into play. You need an audit trail. You need to be able to find, okay, we used to have this money, and now we don't have it, or he had this account, I wasn't aware of it. I have to track where this money went, it's no longer in that account. And you have to be able to follow from point A to point B to point C and so forth, where the money went, so that you can show whether it has been just fully spent, and then what was it spent on, and which, if it was spent on another woman or man, potentially you can ask for that portion of the money, even if it's gone, to be taken from the other spouse's, the spouse behaving wrongfully, portion of their marital assets, so that you can be paid back maybe from an asset itself, although the cash may no longer be available. Financial documents become very critical. Credit card statements, bank statements, investment statements, travel. You may want to have to go back and prove that he traveled with his girlfriend and the expenditures on on that actual trip. So another example of where financial documents are very, very important. Okay, financial documents, and they're important in drafting family law agreements. Keep in mind that whether when you're, for instance, getting into a pre or post-nuptial agreement, one of the most important and actual crucial things, I would say, for the success of any of these agreements or enforcement, the validity of these agreements, is transparency and disclosure. So you have to disclose everything that you have. If you withhold disclosures or documents, the other party can easily attack the agreement as being inappropriate, as being invalid, because you were not given a full disclosure and you were unaware of what you were actually waiving when you waived it. Okay, so in this kind of case, this is also where you want to give you want to be as transparent as possible. Give tax returns, business tax returns, trust plans, business operating agreements, brokerage statements, everything that you have, anything and everything. and keep an identification as to what you've given to the other party so they cannot say later on they did not receive this. Whether you're making it an exhibit to the actual agreements or they're identifying it somewhere else that they have received X documents, X amount of years of tax returns, X amount of years of income, brokerage account, and so forth. In a marital settlement agreement, it's also equally important to actually have documentation so that when you're entering into these agreements, like we talked about in equitable distribution for alimony purposes, that you're entering into a fair agreement and you're actually agreeing to terms that actually exist, and that you're not leaving something on the table, shall I say, right? So in other words, later on you find out, because marital settlement agreements are very hard to invalidate. Okay, most of the time it has to be some kind of fraud, although financial affidavits do not have a statute of limitations on them. So if someone did fraudulently rely on the financial affidavit and you indicate in the marital settlement agreement that you actually relied on the financial affidavit into this agreement, that could provide an easier basis in order for you to show that there has been fraud and to invalidate some or all of the agreements, the marital settlement agreement. But for the most part, if you just agree that no further disclosures are necessary, and you'd agree to certain terms and later find out that there was additional assets or additional income and you could have gotten more money, it becomes hard because you've waived your right to discovery. So you need to make sure you're fully satisfied. It might cost a little bit more money, take a little bit more time, but you don't do this every day. You want to make sure that you do it right. It does affect your future for, going forward, and potentially your ability to succeed and move faster into a post sort of divorce life, and knowing what you have. So very important also, financial documents in family law agreements. People assume, well, it's an agreement, it's not as important. It's just as important. It's just as if you're going to buy a business and you don't ask to see under the hood, so to speak. You don't ask to see the inventory, the actual sales, if what the owner is telling you is true. So unfortunately, although it may seem a little mechanical, you have to remain objective in these type of circumstances. Try to put the emotion aside. It's very hard in family law cases. And look at these documents to understand, to make sure you understand. Also, a lot of times my clients are, Regina, I don't want to see it. It's hard to see these documents, credit card statements, and so forth. Part of the problem is that as a lawyer, I cannot, in my firm, we can see things that may look funny. We can see money going out of an account, trace it, although most of the time a forensic accountant will do that. But us as lawyers in general, we do that. We need to look at that to understand discovery and see if we need more information, or if there isn't a forensic accountant, they will let us know. But I don't know if something is usually normal. So you'll know your spouse better than we will. You'll know, oh, they never go to Fort Lauderdale. Why is there a charge in Fort Lauderdale? Wow, I never even knew they went to Belize. I never even heard that. They said they were going to New York. Those are things that we would not know that are inconsistent when we're looking at them, because we don't know your spouse's habits and behavior. So something, it's difficult, but it's important that you stay also engaged in this process and that you assist the attorney in producing your documents also, so that we avoid the appearance of the court thinking that you're being difficult, also and cagey and don't want to cooperate. It makes it a lot easier when you cooperate to say, to make the other side cooperate and show that they're not, to keep the focus on them if they are misbehaving, so to speak. Which brings us to, this picture, which just kills me. He just did such a fantastic job in this movie, but financial disclosure is me and he's laughing. And I'm telling you, a lot of times that is the case. That's what the other side is doing. Ha ha ha, you're never going to find that, never going to find the money. I hid it so well, and they smile. So it's important, even if you're contemplating a divorce in the future, it sounds difficult, but you want to make sure you understand where everything is, all the all the money, where the documents are, you understand how things get paid, from what account, what assets that each party has. You just want to be, there's no reason not to be informed. It's really important in general just to be informed, whether you're a man or a woman, of what's going on, even if you're not doing the day-to-day work. You can also assist your partner, which they may be helpful in that. You also see how things are spent and why they maybe appreciate sometimes what also the other party is saying, just so you understand, honey, you're spending too much, or, the kids are this is too expensive. There also lends itself in general, even in an intact marriage, to helping each other out and being more helpful. And if you are on your way to divorce, it's going to be helpful to keep an eye on these things from much early on, because much more often than not, I see a lot of divorce planning a year, 2 years ahead of time, and it's much more difficult to catch up for the other party. Expensive in litigation, it becomes a battle. So important to try to keep these documents in general together. And if you're about to go through divorce, I would stop to try to gather everything. so that you understand it before you're going through the more difficult, aspects of it, litigation. So I don't know if anybody has any questions and answers. I think at the beginning, I forgot to tell everyone, if you did, to please put it into the chat room. But I think everyone, I already have some in the chat room, so everyone knows what they're doing. Everyone's become Zoom professionals. So here I have some questions. What if one party refuses to disclose bank statements or accounts? Well, it's ironic because it happens more often than not. They don't actually want to come out straight and say, I'm not giving you this document. A lot of times, they'll say that pre-suit or potentially before any kind of discovery requests or minimum disclosures are required, or discovery requests have been served on them. But basically, if they're not cooperating, it's your attorney's job, or your job, if you're pro se, to file a motion to compel with the court and require this person to comply with giving over these documents. You can potentially also subpoena documents. The problem with that is you want the other party to indicate to you what they have and don't have under oath. Because you can subpoena documents from one bank, but you may not be aware of the fact that another bank exists. So even if you try to subpoena documents, which is not necessarily a bad thing to do either, even if you get the documents, because you want to make sure that none of the documents have been tampered with from your husband or wife, because unfortunately Adobe is very handy nowadays, and you never know when something's been tampered with. But unless the person is very sneaky, you don't always have to subpoena the records in addition to getting them from the other spouse. But if you have a question, concerns about it, you should even ask for an IRS, transcripts to make sure that what was produced was actually what they're saying. So that's one way to do it. But it unfortunately becomes a cat and mouse game. And if they try to tire you out, they try to tire the judge out, that, oh, here, I gave her that document. And then when you go and inventory it, you see that they're missing a bunch of statements or pages that are relevant. So unfortunately, it becomes a cat and mouse game. The more organized you are, and the more that you know what exists, the easier it is going to be for you. Okay. So we have a question here. Can parties waive mandatory disclosures if there's an agreement? Only if it's a simplified divorce. The courts and the judges are required to take minimum disclosures, which are financial affidavits and certificate of mandatory disclosures, particularly financial affidavits, right? But they usually like to see at least an exchange of the minimum mandatory disclosures. When does a person have to supplement mandatory disclosures of financial affidavit? So actually under family law, although this doesn't necessarily exist in civil law in the state courts, each party is under a duty to supplement when something becomes materially changed, or there's been something that has to, so in other words, you bought a house, so now you have to update your financial affidavit, and you have to update your bank statements and your loan statements and so forth. So there's a duty under Rule 12.285 to supplement throughout the case in general, all of your documentation, but also change and amend your financial affidavit or some statements or interrogatories, RFPs that you may have produced in the past, amend the responses for them to be accurate if they're no longer accurate. Okay. If I'm planning to get divorced, what should I do to plan so that the other spouse doesn't hide his actual income and expenses? Well, we've talked a little bit about that before, especially if it's sort of divorce and you're anticipating that the person is kind of planning it, and they're sort of planning their exit, and all of a sudden income seems to be getting reduced, and they're selling assets, and there's a lot of mayhem going on, and you can't quite confirm it because they also will not let you confirm that this is the case. Keep an eye again on the financial documents. Try to write things down when they may have said something to you, so you can capture the time and the moment which they're saying it. So it's easier to go back to those financial documents if needed and trace it back. Keep an eye on where the paycheck is going. If they've now become difficult in putting their paycheck into another account, do your best to just keep track of, with your listening sort of ear on the ground, so to speak, of what is going on and document it, so it makes it easier to go back and find this information. Also note when there's unusual expenditures, might indicate that a bonus was received or additional income, and you don't know where from. Sort of just make a note, write it down, and ask, but you're not likely to get an accurate response if they're hiding, but at least it tells you what it's going to show you that they lied to you, that you need to keep a closer eye on things, basically, and then a closer ear to the ground, and then watch everything, the mail and everything else. Okay, so what do I do if my spouse is hiding money? Well, we did talk a little bit about it before, how you can find that out through financial documents that are produced, through the process, and that you should insist on, but you can also use subpoenas, request for production of documents, interrogatories. Depositions are a great tool. They're free-flowing. The questions just are asked. The person has to answer the questions. without haste, so to speak. If they don't, they run the risk of there being sanctioned for inappropriately stopping a deposition. So those are different things that you can do. It is unfortunately sometimes a process to chase someone when they want to hide money, and it usually has a certain level of success, and they know that. So if they can, if they can tire you out enough, they know you may want to give in before you find all the money, or it may cost so much money you may decide to just give in prior. So the amount of sort of money that you put into an energy into it really has to depend on what you're trying to chase, and it doesn't have the value that you think it has. Sometimes it just makes sense to make a deal and walk away from them and not, so in other words, you don't want to spend $100,000 in litigation to find $50,000 that they may have stolen, of which 25 would be yours. So it doesn't really make sense. These are the type of questions you always need to be asking yourself. And does it make sense to do this or chase this? Is it worth it? That's for understanding the value of things, and your rights is very, very important. Also, alimony. So they said, thank you for all this information. You're welcome. Hopefully it's been helpful. There are children, if there are children and also an alimony claim, which one gets figured out first, and does it affect one party's income? Is there a specific order? Yes, normally alimony has to be figured out so that you can determine the child support amount, because child support is uses an alimony amount to determine whoever's getting the alimony's income, so to speak, the party's income. So when they actually run the equation. Okay, so how do gifts from family members affect a person's income in a divorce proceeding? For example, if my father pays for my car every month as a gift, will that count as income, or can it be included as an expense? See, this is when we get a little bit into a dicier area of the law. If you are consistently getting help from a parent or a friend or somebody else, it's most likely going to be imputed to you as income, because it's consistent, and the court is going to make a determination that your parent is always going to be helping you, so it offsets your needs. So the car becomes an expense for you, but at the same time, you're also going to be added income from the parent if it's fairly consistent. If it's random gifts here and there, and there's nothing consistent, they're discretionary, less likely the court is going to be to impute the income to you, because it's not regular and it's not consistent. So, basically, let me see what other questions. Okay. What is the best way to protect a premarital real estate property with a mortgage on it without having your spouse sign a prenup in the event that the spouse is moving into a premarital property after the marriage? Well, I think we touched upon this a little bit already. And basically, if you're not going to do a prenup, it's ironic, because I would say, first thing I'd say is draft a prenup. Best way to protect it. And to make sure that there's, everyone understands, if I put money into this, I'm still not going to get it. If the other spouse that did not own the property premarital puts money into it or efforts into it, if the prenup says they don't get any appreciation or value from that, at least the party knows before they do so. Here, you're going to have to use the law, the defaults like other containing law, and be very, very careful. So the rule here usually is with a premarital, property or non-marital property, but it's premarital. That's why it's non-marital. Is any passive appreciation normally is not considered a. So if the house increases in value because you just sat there, literally, you all used the house, so to speak, for 10 years, did nothing to it, but it increased in value because of market force. Most likely, that's not going to be considered marital in any portion. Any appreciation of that will not be considered marital. However, if you do improvements to the house, or you have a mortgage, as this question seems to ask, and marital money and income and efforts are used to pay down the mortgage or to improve the property, and the appreciation of the property is through active appreciation or sort of payments, there's an equation on how you figure out the equity, so to speak, that might develop as marital from the payment of a mortgage. That portion of it will be considered marital. So most people don't realize that, and that's a big trap. It becomes a huge, very expensive litigation mess to sort out, so to speak. It's also why the more disciplined you can be with financial documents and expenses. I know that doesn't sound exactly romantic, but it'd be very helpful in these kind of cases, especially if that's the understanding between the parties. Okay. Ultimately, I recommend a prenup, but in other case, you can also do a postnup too. After the case of the parties willing to do so after the marriage. So what is the likelihood that a homemaker in a marriage considered short-term in Florida will have a more long-term alimony granted when the working spouse was the one that told her to stop working so she could stay home and take care of the children? And now the homemaker spouse has been out of the workforce for at least 5 years. Well, that's kind of tricky because unless short-term marriages, normally you're not going to be entitled to much alimony, or you may be entitled to bridge the gap alimony or rehabilitative alimony in order to get you back into the workforce if you need some kind of retraining or reskilling, or bridge the gap just to give you some time to adjust, back into the workforce. So it might be a year, 2 years. You are also entitled potentially to durational alimony, cannot exceed the term of the marriage or the length of the marriage. And in some rare occasions, very rare, or special need, short-term marriages can actually require permanent alimony, but it's very rare, exceedingly rare. So in this circumstances, unless it's in writing the promise, and you can assign a certain damage amount or a certain amount that would take to for the other spouse that promised this to you in writing, and you relied on it basically to stay out of the workforce, and now you've been detrimentally affected. Assuming the bridge of the gap or rehabilitative alimony is not sufficient, you might be able to enforce something like this, but normally they're not enforceable usually across the world. And it becomes difficult for the court to prove if that really happened or didn't happen. So once again, this is where prenuptial and postnuptial agreements come into handy. If someone is going to make you this type of promise, let them put it in writing and articulate what it is that you're going to get in the event of divorce, so that you're not hindered by not necessarily hindered, because you don't necessarily mind staying home being a homemaker and taking care of the children. The problem is that does ultimately lead to a financial detriment for you and sort of a weakness when you try to get out, you go to work and you relied on that in order to make this decision to stay home. So the best thing I can tell you to do is to get a prenup or a postnuptial agreement and put this in writing. Last question, how would a spouse's interest as a partner in a firm, such as a law firm, if such interest was obtained during the marriage, be split up at the time of divorce? Okay, well, thankfully right now I'm not married, so well, law firm's a little bit different too. There's certain professional sort of companies and associations that you have to actually have a law degree, or like an architectural degree, licensing, or an accountant to be able to actually own an interest in a company. For instance, if I were to get divorced and it was supposed to be split up, in most cases, the courts are not going to require, there's never a hard and fast rule, but for the most part, the courts are not going to require, well, let me step back. It also depends on whether or not the company's in both parties' names, or both parties active and receive an income from the business itself. But for the most part, well, the courts cannot make the parties continue to work together either after a divorce. So the courts will be required, if the parties don't want to work together, to either give, depending on if there's also alimony, that could also complicate to some extent the issue, depending on the equitable distribution, although first you have to distribute the assets. It depends on who's going to, if someone lost income, if they're going to receive alimony, can they go, is there a non-compete agreement? Although that's a little bit tricky under Thompson versus Thompson in Florida, but that particularly affects the actual valuation of the non-parties, sort of the non-business parties, the one that's not going to take the portion of the businesses, and is going to receive sort of cash payment for their interest in the business, so to speak. That affects actually the valuation of that interest, which is unfortunately, I think, very negative right now, and it's a disadvantage for that particular spouse, the way they figure out the valuation of it. But basically, most of the time, the courts will look to just buy out one of the parties if it's possible. If there's cash or other assets they can use to offset that person's interest in the business, so they can try to preserve the business itself. Because most of the time, that is also an income source for one or both parties. So it can get a little tricky depending on the circumstances, because you also sometimes you have loans in businesses that both parties may have personally guaranteed. So it can get a little bit messy, in which case you have to find a way to, is it just easier to sell off the business at that point, and remove the assets? Is there a way that the other party can indemnify, remove the other non-party's, name from a loan or a liability in the business? So it becomes a little bit tricky, but that's an example of what may happen. So I want to thank everybody for joining us. I want to stay tuned for our next webinar, which is why a shareholder partnership agreement is necessary. It's going to be May 6th at 10 a.m. This webinar focuses on why management agreements between partners, shareholders, and owners are important and necessary in order to avoid disruptions in business due to circumstances such as the 5 Ds: a dispute, divorce, debt, disability, and death. So please come join us. Hopefully it'll be helpful and informative. And I want to thank everybody. This is our contact information. If you'd like to ask us additional questions or need any assistance, please let us know. Our contact information. And thank you again for being present. Thank you. Take care.